Good morning, all, and welcome back to the session of financial management. And this session, we will try to cover a revision of unit number three. So, our unit three is all about investment decisions. Technically, it is known as a capital budgeting. So, first we try to understand what do you mean by capital budgeting, and then after we go for the practical aspect of this unit. So here a budget means a document which represent the future incomes and expenditure. And capital budgeting means a process of preparing budget for the capital. It is the entire process that how companies are preparing various budgets, how companies are estimating the capital for the future. That is all about capital budgeting, and some of definitions are given to you. Okay, so one of the important definitions for all of you given by the IM Pandey, that capital budgeting decision may be defined as the firm's decision to invest its current fund most efficiently in a long run activities in anticipation of an expected flow of future benefit over a series of years. So, according to the Pandey, capital budgeting is a one decision in which company invests the funds in some of investment opportunities for a long run, and they are investing because they want some benefits. Yeah, benefit means company wants a return from that investment. So that entire process, that entire decision is known as capital budgeting. Next, we have a process of capital budgeting that may be asked in a theoretical question for 4 marks. Mainly, five steps are there. Step number one, project generation. First, in a project generation, company need to identify the investment opportunities. Where should we invest? Where should company invest in a bank? Okay, in a post office, in a share market, in plant, in factories, in building. Where? Number two, project evaluation. It means evaluation of opportunity, evaluation of various alternatives. When it's come to the evaluation, we need to check three parameters: time, return, and risk. These three parameters are there for the evaluation of each and every project. Here, project means investment opportunity, where we invest. Number three is a project selection. After the evaluation, we will find that this project is giving more return, this project having less risk, this project gives a return very quickly within a short period. So based on that three criteria, we select any one or two projects. Then after, step number four, project education. It means project implementation. So now we go for the investment. Now we go for the actual spending of money for that particular option, for that particular objective. And lastly, we take a follow up. Step number five, follow up. So after a particular period, generally 3 months or every year, company take a feedback for that particular project, that I have invested 5 lakh rupees in a bank FD. What will be the return after 1 year, after 2 years, after 3 years? That we will check every year. That called follow up. So these five steps are there. Please remember: project generation, evaluation, selection, implementation, and follow up. Then after, next is very important for all of us, because the next is a practical aspect of this unit. And in final examination, in a mid two examinations, our main focus is toward only practical questions. So I have mainly focused on a practical question, so this will give you a practical aspect of this unit. So techniques that which help us to identify the best investment for us, best investment for the company. So these techniques are called capital budgeting techniques or investment evaluation techniques. All the techniques are categorized in two different categories: traditional techniques and modern techniques. Traditional techniques, also known as non discounting techniques. Modern techniques are also known as discounted cash flow techniques. So now we go for each and every method in detail, okay, with a practical question. So let me allow for a new screen. Are we clear up to this? Okay. So now you can see the Google Sheet, which I shared with you. Mainly three techniques are there in traditional techniques: payback period, accounting rate of return, and discounted payback period. First, we have started with the payback period. Okay, your calculation for payback period is very simple. Shortly, it is known as PBP. Please remember payback period, shortly known as PBP, and formula to find out the payback period. Is PBP is equal to project cost divided by annual cash inflow. Annual cash inflow. Now you can see here in exercise number one. Okay, in exercise number one, project cost is 30,000. So let me write the formula first. Okay, you need to write this formula, okay, to find out the payback period. So here payback period is equal to project cost upon annual case inflow. Now see here, project cost is 30,000. So you write here 30,000 divide by annual case inflow. See the second line, the case inflow are rupees 10,000 for this company. Okay. Sorry, for this project. So 30,000 upon 10,000, you will get 3. Please remember all the payback period always we have here. Okay, whatever the answer you will get, that must be in here. Are we clear? Okay, cost upon annual case inflow. And see here, your payback period is 3 years and life of the project is 5 years. If the payback period is less than the life, then it is accepted, otherwise it is rejected. So this project is accepted because A is uh, payback period 3 years is less than the life of the project. Are we clear about the first method? Now see, if this case flow remains same for all the years, but in most of the practical question, you will find that in real life, the case and flow is not remain same for all the years. Okay. So for that, we have uneven case inflow method. Again, it is a part of payback period. Please remember, in a payback period, we have two types of practical question. A practical question one, in which the case inflow, it means this 10,000 is remains same for all the years. Case inflow remains same for all the years. And second, we have when the case inflow for each and every year is a different. Okay, you can see here the project cost is 25,000 in question number 4, and case inflows are 5,000, 8,000, 12,000, 7,000, 3,000. It means the profit case inflow is not equal for all the years. When it is not equal, we need to prepare table like this. Okay, you can see this table. Okay, first we write yours. Number 2, we write a case inflow as it is given in a practical question. 5,000, 8,000, 10,000, 12,000, 7,000, and 3,000. Then we go for the column number 3, and that column number 3 is total case inflow. How we find that? In the first year we have 5,000, and the second year 5,000 plus second year case inflow 8,000, you will get 13,000. For the third year, for 5 plus 8 plus 10, you will get 23. For the fourth year, 5 plus 8 plus 10 plus 12, it means 35,000. For the fifth year, 5 plus 8 plus 10 plus 12 plus 7. Okay, 125. You need to do the total of 125. Will get the case inflow, total case inflow for fifth year. And for the sixth year, you need to do the total of this all the amounts 126. You will get the case inflow for the sixth year. Now, what is a case outflow? What is a project cost here? That is our main aspect. Your project cost is 25,000. So we need to consider that 25,000 as a base. So now you can see the third column, the total case inflow, in which year this 25,000 is recovered. Say in a first year we have 5,000, in a second year we have 13,000 not recovered, and a third year we have 23,000 recovered, but only 2,000 is remaining. Okay, So in a fourth year, total case inflow is 35,000. It means during 4 years, we are able to cover 25,000 rupees. So we write the formula like this: payback period is equal to year before fully recovery plus unrecovered amount and case inflow during the year. Now you can check here. Okay, let me remove this part so you will get the idea. Year before fully recovery. In which year we have fully recovery? In a fourth year. Okay, so year before fully recovery means 3 years plus unrecovered amount. You can see here which amount is unrecovered in during the third year. 23,000 we have recovered. We need to recover 25,000. So 2,000 is remain. So note down here 2,000 upon case inflow during the year. In the fourth year, case inflow is 12,000. So 3 plus 2 upon 12. Do the calculation. 2,000 upon 12,000. You will get 0.16667. And to convert this 0.1667 into the month, you need to multiply with the 12. You will get the idea that the final answer is 3 years and 2 months. Are you with me? This is our first method, very, very important for mid-exam and for final exam. Again, I repeat, you need to prepare the table, write down the years, write down the case inflow, and the third column, find out the total case inflow. How you find? Just do the total of all the years case inflow. Okay, for the first year, only 1. For the second year, 1 plus 2. For the third year, 1 plus 2 plus 3. For the fourth year, 1 plus 2 plus 2 plus 3 plus 4. Okay. Like this, we have done the question number 7. Similar question, okay, in which we have calculated the payback period. Are we clear? This is our first method, payback period. Now we move for the next method, and that next method is discounted payback period. All the calculations are same, but additionally, we need to find out the discounting factor in discounted payback period. Rest of all the calculations are remain same, formula remains same, but instead of case inflow, we take a discounted case inflow. And to find out the discounted case inflow, just we need to add only one column, and that column is discounting factor. Generally, it is given to you in a practical question. You can see the question number 6. Year is given to you 1 to 5. Profit is given to you. Okay, 7, 3, 8, 5, 4. Then after see your discounting factor is there. So we have looked at to the discounting factor of 10%. For a discounting factor, we have table. Okay, you need to use that table to find out this discounting factor. Okay, write down the discounting factor. Now multiply the column 2 with the column 3. You will find discounted case inflow. Okay, and then after calculations and steps remain same. There is no change. Do the total 1. Do the total 1 plus 2, 1 plus 2 plus 3, 1 plus 2 plus 3 plus 4, and 1 plus 2 plus 3 plus 4 plus 5. Are we clear? Again, formula remains same. Year before fully recovery plus unrecovered amount case inflow during the year. Our target is to 15,600. We need to cover this amount. In which year we have covered this amount? In the fourth year. So year before fully recovery is 3, unrecovered amount 746, and case inflow during the year is 3415. You will get the answer 3 years and 2 months. This is our first method, payback period. Now we move for the next one, accounting rate of return. Accounting rate of return. Please remember, in accounting rate of return, we need to find out the average profit. Okay, and you are aware about that, how we find the average profit. And this is only the one method which use a profit instead of case inflow. Except the accounting rate of return, all the methods use case inflow to find out the answer. In this accounting rate of return or average rate of return, we use net profit. instead of case inflow. Please remember that may be asked in 1 mark or MCQ question. To find out the accounting rate of return, we have formula average annual profit after tax upon initial investment into 100, and always you will get answer in a percentage. So first you need to find the average profit, and you all are well aware that how to find average profit. Total of profit divided by number of years. So here profit is 40 plus 60 plus 70 plus 50 plus 20 and divide by 5, so you will get 48,000 as average profit. Initial investment is 5 lakh. Okay, so 48,000 upon 5 lakh into 100, you will get 9.6. So this is very simplest math. But when it's come to average rate of return, here we have accounting rate of return. But when the question asks that find out average rate of return, instead of initial investment, you need to find the average investment. And please remember this formula: average investment is equal to initial close plus scrap value divided by 2 plus additional working capital. So initial investment here you can see 4 lakh rupees. Working capital is 0. Scrap value is 0. So 4 plus 0 upon 2, you will get the average investment 2 lakh rupees. Okay, and your average profit divided by average investment into 100, you will get average rate of return. In average rate of return, we use average investment. In accounting rate of return, we use initial investment, original investment. Okay, and last but not least, in some of practical question, you will find that net profit is not given to you directly. Okay, the net profit is given to you, but it is before the depreciation and before the tax. So if it is not given, then you need to find like this: profit before depreciation and tax, then after less depreciation, okay, then after less tax, and then after whatever the profit is there, that profit is called net profit or profit after tax. This profit we will use to find out the average profit. Please remember, again I repeat, if in a practical question profit before depreciation and tax and interest is given to you, you need to deduct the depreciation, you need to deduct the interest, and you need to deduct the tax. And for that, all the things, for a depreciation, for a interest, and for a tax, some of information will given to you, that 5% depreciation charge, 10% interest charge, or 30% tax rate. This all the informations will given to you, so no worry about that. After that, accounting rate of return. Okay, up to this we have discussed traditional methods: payback period, discounted payback period, and accounting rate of return. Now we are moving for the next method, and that is discounted case inflow techniques, or modern techniques of capital budgeting. Again, we have three techniques: NPV, PI, and internal rate of return. Please remember the short form and full form. NPV stand for net present value, PI stand for profitability index, and internal IRR, internal rate of return. And maybe the question asking in MCQ that in internal rate of in IRR, I stand for what? In NPV, N stand for what? In PI, P stand for what? Are you getting the point? This type questions may be there in MCQ or in 1 mark question in final examination plus in mid examination. Now we go for the first method, NPV method. Please note down somewhere. This is very, very, very important for mid and for final examination. I will give you the guarantee that minimum 1 to 2 question will be there from NPV and PI. Minimum. Okay, and it's having value or weightage of 8 marks. Now we look at the first practical question of NPV. Okay, you can see here case outflow for project A is 65,000, for project B it is 60,000, and discounting factor is a 10%, and case inflows for project A and project B is given to you. Okay, and that is 10,000, 12,000, 20,000, 23,000, and 25,000. Whenever this type of question is there, okay, I will do this calculations once again here in the same sheet. when we need to find out the NPV, at that time we need to prepare one table. Okay, and that table having 4 columns. And table is look like this. For time saving purpose, I am just preparing this table, similar paper table here. Okay, you can see this table we need to prepare for each and every practical question whenever we have NPV. Then after write down the years and case inflow. First we go for the calculation of project A. So note down the year and case inflow like this. Okay, like this. Whatever the information is given to you, just we have recorded the information. Are we clear up to this? Prepare a table having 4 columns and write down the years and write down the case inflow. Now, what you need to find? Discounting factor. How you find discounting factor? For that, there is a one separate table that you need to use, or else you can do this calculation manually in your calculator. Okay, like this, 100 upon 110, press the sign equal, again press the sign multiple, and then after equal, how many times you will press equal, for that years you will get the discounting factor for 10%. But I request you can please use the table instead of calculator. So you will get the clear idea. So we go to the table, okay, we find the value in the table and we put this values here. Okay, already we have find it out. So time saving purpose, I'm not going for that explanation. Okay, write down this discounting factor here. Okay, this is your discounting factor. Now column number 4, discounted case inflow is nothing but a multiplication of column number 2 with column number 3. And you will get these answers. You need to do this for all the years. For 1 to 5 years. For all the years, 2 into 3, 2 into 3, 2 into 3. And lastly, you need to do the sum of all the years from first year to second year. You will get this answer. Are you with me? Okay, as you get the sum total of this all the years, this amount is 65,261.7, and see the case inflow for project A, that is 65,000. So if we need to find NPV is equal to total discounted case inflow minus total outflow or a cost. So here discounted case inflow is 265,261.7 minus case outflow or total outflow is 65,000. Your answer is 261.7. If this answer is more than 1, more than 0, the project should accept it. And if we have 2 different projects, okay, then in whatever the project we have higher value, that project must be accepted. You can see here in a B we have answer 673, in A we have answer 261. So in a B, NPV is higher. So out of A and B, we need to select B instead of A. Are we clear about NPV? Again, quickly I repeat, because this calculation remains same for all the remaining methods. Again, I repeat to you, first you need to prepare this table. First, write down the year, write down the case inflow as it is given in a practical question. Number 3, find out the discounting factor. You can use a table. Okay, that table will provide it to you in your examinations. So use the discounted factor table for a 10%. and see the value for first year to 5 year. You will get these values. Now multiply discounting factor with the case inflow. You will get discounted case inflow. Then after, just do the sum total of column number 4. You will get the total discounted case inflow. Total discounted case inflow minus case outflow, you will get the NPV. And if the NPV is more than 1, then it is accepted. If it is less than 1, it is rejected. Are we clear? This calculation, these methods remain same for all the practical question. Here we have two projects. So first we done the calculation for A, then similar calculation for B. Okay, and then next method is profitability index method. Okay, only one additional step that you need to find out. Instead of this plus minus, okay, what we are doing in NPV, the total case discounted case inflow minus case outflow. Instead of this minus sign, you need to use division sign. In NPV, we are deducting the case outflow from the total discounting factor. You need to divide this case outflow by the total discounting factor. So here you can see here, okay, in equation exercise number 10, your total discounted case inflow is 1,12,381 and case outflow is 1 lakh. So to find out the NPV, total present value minus initial investment, 1,12,381 minus 1 lakh. Your answer is 12,381. And to find out the NPV, only one change, total present value divided by initial investment. Instead of minus, you need to use division sign and you need to do the division. So 1,12,381 divided by 1 lakh, you will get 1.123. This is the only difference between NPV and PI. The rest of all the calculations are same. Again, okay, in NPV or PI, you need to prepare this column, your case inflow. You need to write a discounting factor. You need to find discounting factor 2 into 3. Do the total. You will find total present value or total discounting factor. Are you with me? Now, next and last method, internal rate of return. Internal rate of return. Only one additional calculation that you need to do here, and that is, okay, in each and every practical question, you need to assume, you need to use a two different discounting factor. Rest of all the calculations are similar to the net present value. We are again going for the net present value calculation, but what you need to do first, you need to calculate net present value with the 10%, because as I interpreted in the classes that first you go with the 10% discounting factor, you will get some answer. If you will get NPV, net present value, in a plus answer, okay, in a positively, then you need to increase the discounting factor. As you increase the discounting factor, your NPV becomes minus. So in internal rate of return, we use the same calculation as we are using in NPV. Write down the years, write down the case inflow, write down the discounting factor, and find out the discounted case inflow, find out the total present value. But here we do this calculation for 2 times, not for a single time, but for 2 times. And why 2 times? Because first we start with the 5% or 8% or 10%, any discounting factor, any percent, we find the NPV. If the NPV is positive, we increase the discounting factor from 10 to 20, from 8 to 12, from 7 to 14, any else. And as we increase the discounting factor, definitely your NPV becomes 0. So we need to prepare two different table for this. First table in which NPV is positive, Second table in which the NPV is negative. How we get the NPV negative? By increasing the discounting factor. Suppose first we have prepared this table at a 5% in example number 12. Okay, then we have prepared the same table at a 10%, but at a 10% we are getting the positive NPV. So again, this is not useful. We need to go for 15%. Rest of calculations are remain same. And you can see this formula. Okay, internal rate of return is equal to low rate plus present value of low rate into high rate minus low rate divided by present value of low rate minus present value of high rate. So this is all about capital budgeting. Three techniques are over. Okay, NPV, PI, and internal rate of return. I request all of you, please do at least one practical question by yourself for each and every method. It hardly take 1 hour, but you clearly get the idea that what we supposed to do in a mid examinations and a final examinations. Again, I repeat, this unit number 3 is very, very, very important for a practical question, specifically NPV, PI, internal rate of return, and payback period. For these methods, it is very, very important. And again, I repeat that net present value question will be that definitely in mid one, in final examination. In both the examinations, definitely you will get the question of NPV, or NPV will be there plus either a PI or either internal rate of return. So all the best and thank you.
Sir, PI 9 equals 10 PIs.